Is Boeing a buy or a sell? Let's get started with the model. This is a large cap company, 123 billion market cap. They're trading at 164 a share, and they have 748 million shares outstanding. Boeing develops, manufactures, and services commercial airplanes, defense products, and space systems for customers in more than 150 countries. They were incorporated back in 1916, over 100 years ago, based in Arlington, Virginia. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Negative free cash flow in 2021, negative 4.4 billion. Much better in 2022, positive 2.3 billion. Then it nearly doubled to 4.4 billion in 2023. But the trailing 12 months is their worst ever, negative 7.4 billion. They're bleeding cash. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative every single year. They're worse in the trailing 12 months, negative 8 billion. Lots of write-downs, and their expenses are getting really high, especially with all the problems they're having. Revenue is a sales for the company, and that grew nicely from 2021 to 2023, peaking at 78 billion. It did come down 6% to 73 billion in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4. That's 149 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $109 billion. We divide that by 748 million shares. And we get a calculated stock price of 145. They're trading at 164, so they're trading at a 13% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 75 companies in the same industry as Boeing, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, as expected, $2 billion. Raytheon RTX spends the most, $2.4 billion. We can't look at a debt to equity ratio. They have negative equity, which means their liabilities are higher than their assets. They don't pay a dividend anymore. They have the worst free cash flow by far. Most companies are positive. They rank 4th in market cap, really close to Lockheed Martin. We can't look at their price to book, negative equity, which means their assets are lower than their liabilities. We can't look at their PE, negative earnings. We can't look at their price to free cash flow, negative free cash flow, lots of negatives. They do have a good price of sales. That's a great thing about price of sales. It can't be NA because you can't have negative revenue. You could have no revenue, it can't be negative. And they generate 73 billion of revenue, second highest on this list. RTX is number 1 at 79 billion. Their revenue has been declining over the years. Their 5-year annual revenue growth rate is negative 13%. Most companies are positive, especially with inflation. The stock is trading at 164, which is fairly close to its 52-week low, so it could be a good time to get in. Their 52-week high is 264. If you put $10,000 into this company 10 years ago and reinvested the dividends when they paid dividends, at one point you'd be negative. That's probably around March 2020, the bottom of COVID. At another point, you'd be over $30,000. But if you still held on, you'd be at $15,500 today, a 4.5% annual return. To summarize, I have them trading at a 13% premium, ranking 6 out of 10. It's a good company, they just got a lot of bad press. It will take a while, maybe a few years, to get out of this chaos. I think it's a good short-term trade because the stock has been coming down, 7 out of 10. Long-term, I think it's good, but I'm not too sure, 6 out of 10. Maybe I should have went 5 out of 10. Terrible ratios, 2 out of 10. 3 out of the 4 ratios are NA. Financials don't look so great either, 3 out of 10. Let's take a look at their most recent 10Q. Here's their income statement, the third quarter of 24, third quarter of 23. Revenue is indeed down. It was 56 billion last year, now it's 51 billion. It's down in product sales, but it's up in service sales. Let's see if they give a different breakdown of the revenue. Of the 51 billion of revenue, 18 billion is commercial airplanes. That's down a lot. Defense, space, and securities is up a little bit, 18.5 billion. Global services, 14.8 billion, up a little bit. They have an operating loss in the commercial airplane segment. They generate 18 billion of revenue. They have 24 billion of expenses, operating expenses, just in commercial airplanes. So they have a loss, an operating loss of 6 billion. Defense, a loss of 3.1 billion. So in defense, they have nearly $22 billion of expenses with $18.5 billion of revenue. Global services, they're profitable, $14.8 billion of revenue, $2.6 billion of operating income. So their total operating loss, $6.4 billion. Last year, it was under $1 billion, the loss. They have a lot of debt. They spent $2 billion of interest on their debt. So they have a net loss of $8 billion. Last year was a net loss of $2.2 billion. And this is for the 9 months ending 9/30/2024 compared to the 9 months ending 9/30/2023. Just for the quarter, they have a loss of $6.2 billion. Most of the loss is in the most recent quarter. They're adding shares. Last year, 605 million shares outstanding, now 616 million. Let's look at a balance sheet. Current assets, $109 billion. Current liabilities, $97 billion. So they do have a current ratio above 1. Total assets, $138 billion. Their biggest asset is inventory, $83 billion. Here is a breakdown of the inventory. $72 billion commercial aircraft, $10 billion of spare parts and used aircraft, and both those numbers are up from last year, so they have more inventory. They also have $11 billion of PP&E, property, plant, and equipment. Their total liability is $161 billion. Their biggest liability is $58 billion, advances and progress billings. Not many companies use this line item. It's really only for really big projects, like construction projects or manufacturing like this. If you have a contract with a company, say a $20 billion contract over 10 years, you don't want to wait 10 years to finally bill the customer. So you may bill them in stages, like every 6 months. Even though it may take 10 years to complete the project, you do want to get paid, so you bill them incrementally. They also have a lot of debt, $53 billion of debt. Since their liabilities are so much higher than their assets, they have negative equity, negative $24 billion. The reason is because they buy back so much stock. They bought back nearly $50 billion of their own stock. If they didn't buy back any of their stock, they'd have positive $27 billion of equity. Because you could see they're a profitable company. They have positive retained earnings. Retained earnings is the sum of all their prior net incomes. Let's look at a statement of cash flows. This is for the trailing 9 months. The way you calculate operating cash flow, you start with your net loss of $8 billion. Then you add or subtract the non-cash items on the income statement. You adjust for changes in working capital. They spent a lot on inventory, nearly $7 billion. So they had a cash burn of nearly $9 billion. Last year, they had positive cash flow, positive $2.6 billion. In their financing section, they had a cash inflow of $650 million. They spent $1.6 billion on PP&E, only $50 million on acquisitions, and it looks like they invested in other companies, $1.8 billion. Let's look at their financing section. They added $10 billion of debt. They paid back almost $5 billion of debt. So in their financing section, they had a cash inflow of $5.2 billion. Let's take a look at the stock on Simply Wall Street. Its last price, $164, $117 billion market cap. It is up in the past week, up 6%, but in the past year, it is struggling, down 34%. This stock chart goes back to 1990. It was $21 a share. And if you bought it in 1990, after about 18 years, 19 years, you'd be pretty much flat. It did break through 400 in 2019. But ever since then, it hasn't gotten even close to that level. It's currently trading at 150, which is where it was trading 8 years ago. So I think it's due for a rebound, but you might have to sit on it for a few years. Simply Wall Street's valuation is almost $300. They say the stock is 45% undervalued. 24 analysts priced this stock at $182. They say it's slightly undervalued. Their revenue back in 2013 was a good amount higher than it is now. It was $86 billion. It peaked in 2018 over $100 billion. And then it really struggled during COVID because a lot of their revenue is servicing aircraft. It came down to $56 billion in March 2021. That's for the trailing 12 months. It has come up since then in the low $70 billion range, but still 30% low than its peak in 2019. They used to be a great stock for a dividend, and the yield was over 3% at some points. In 2019, it was 2.3%. Then in the beginning of 2020, they stopped paying a dividend. The forecast is for them to bring their dividend back in 2026. If this chart's right, they predict the dividend yield to be 0.3% by then. They had nearly $10 billion of debt in 2013, and then it ballooned to $63 billion in 2021. It's a little lower now, $57 billion, still a lot of debt. And their equity has been negative for a number of years. Ever since 2017 or 18, it's been negative, and the negative is getting worse. Equity negative $23 billion, with $57 billion of debt. They do have $10 billion of cash. The way I calculate the minimum cash a company needs is I take their debt, I'm going to round up to make it conservative, pretend it's 60. 10% of 60 is $6 billion, and half of that is $3 billion. Do they have $3 billion of cash? They have $10 billion, so they're okay. In order to service the debt, they need to have at least 5% of their debt in cash, because I'm assuming a 5% interest rate. Half the companies owned by institutions, 45% by the general public, and 4% by their employees. The biggest shareholder is Vanguard at 7%, Capital Research, BlackRock. The employee stock plan, Geode 1.5%, T. Rowe Price 1%, Morgan Stanley 0.75%, Strategic Advisors, Schwab, JP Morgan 1/3%. And their employee count hasn't really grown. It was 168,000 in 2013. Now it's 171,000. Still a lot of employees. And the ticker trades on the New York Stock Exchange, London Stock Exchange, Mexican Bolsa, Lima Bolsa, Deutsche Börse, Bern, Zitra, Santiago, Wiener Börse, EuroTLX, Bulgaria, Kazakhstan, Santiago, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. If you want to learn how to build the discounted cash flow model, watch the video in the top right corner.